It just makes sense. I've said it many times in the videos. It's paying tax on the seed and not the harvest. Pay on the smaller amount and then allow it to grow, and don't have a partner in your growth. Don't have the silent partner, the IRS, Uncle Sam, in the growth of your retirement account. I talk about Roth conversions a lot. I'm not alone in that. Most financial advisors talk about Roth conversions a lot. But today I want to talk specifically about Roth conversions. One, what they are. Two, how do they work? And three, I'll give you a real world example as to why you should consider looking at a Roth conversion for somebody who's saving for retirement. So first off, what is a Roth conversion? Well, here's the thing. Most of the retirement money that's saved in our country is saved into traditional vehicles, traditional IRAs, 401ks, 403bs, and it's done, when I say traditional, I mean pre-tax. You put it in, you get a tax deduction now. It grows tax deferred. You pay the taxes on it when you retire and you draw the money out someday in the future. And we were told that that was good business, right? You're in a higher tax bracket now than you will be when you retire. Tax rates will be lower when you retire. Get the tax deduction today. Everybody's heard that for many years. Here's the thing. It doesn't look like that's going to be as true as we think that it is. Government spending has been out of control for some time. And at some point, it's highly likely that we have higher taxes. We've got record low tax rates right now. We know that tax rates are going to go up in 2025, at the end of 2025, when the Tax Cuts and Jobs Act goes away. The temporary tax rollbacks that took place, those are going to go away. Tax rates are going to go up by default. So a Roth conversion is the act of converting some of that traditional money into money that will be tax-free. Now, to do it, you've got to pay taxes. To do a Roth conversion, if you say I have this money that's in a traditional account and I want to move it to a Roth, you can do that. You pay the taxes on it now. That can still be beneficial if you've got a time frame before you're going to use the money. To pay the tax on it now, make it tax-free. It can continue to grow, but you're not going to pay tax on that growth in the future. I'll explain that to you in step number 3. Now, how does it actually work? Let's say that you got $300,000 in a traditional IRA or an old 401k from a previous employer, and you want to convert it into Roth money. You can do that, but you've got to pay taxes on the money. Now, it probably doesn't make sense to convert $300,000 in 1 year to pay taxes on it all at once, because our tax rates are progressive. The more you make, the greater the percentage of taxes that you have to pay. But you can do Roth conversions over the course of multiple years. So you can create a plan for yourself to say, I'm going to move over a portion of this money over a number of years and then end up getting it all into a Roth vehicle where I don't have to pay taxes on it again in the future. One of the strategies that we suggest for that is something called filling up the bracket, looking at where your adjusted gross income is going to be. How much space do you have in your remaining bracket before you would trip over into a new higher level? And oftentimes that's a dollar amount that we can look at converting each year while you convert over all of the money that you'd like to be Roth money without taking the whole big bite all at once. Couple of things about how it works. So you got to pay the taxes on it in the tax year that it happens. You can withhold money from what you're converting and pay it out of the account, if you will, or you can just write a check for it when it comes time for your taxes. Second thing, there's no penalty. Sometimes I get that question. People will say, well, I'm under 59 and a half. If I want to do this, do I get penalized? The under 59 and a half penalty does not exist for a Roth conversion because you're not taking out the money to spend it. You're moving it into a different retirement vehicle. So there's no penalty. There's just taxes due on the amount that you're going to convert. One last tip, I got a whole video about it, but if the market's down, it can be a good time to look at Roth conversions as well, because you're able to convert a larger amount of the account because all of the assets are worth less than they were before. You pay the tax on that dollar amount as you convert it, and then hopefully as it just recovers, that becomes money that you didn't really end up paying taxes on at all. So why would you even do a Roth conversion? Who wants to pay taxes on something now if they can just wait to pay them in the future? That's why we're in this problem in the first place. Here's the thing, the math works. If you're 50 years old, let's assume we got a 50-year-old here, they got $250,000 that they would like to get converted. It's traditional IRA money. They want to get it into the Roth. They're in a 24% bracket, and let's say that they earn 7.5% per year on the investment itself. They got 20 years before they're going to use it. So $250,000, 24% bracket, $55,000 roughly in tax that they're going to have to pay. Probably don't want to pay that all in 1 year. Spread it out over a couple of year period, but you get the point. We're going to convert over $250,000 into Roth. It's going to cost us $55,000 in taxes to do it. Why would you do it? Well, you got 20 years. If the money continues to grow for 20 years at 7.5%, you know what it grows into? $1.1 million. I think it's 1,113,000 and something. I'm going to put it up on the screen so you have the exact dollar amount. So here's the thing. Let's say that they get to retirement. Now they've got this $1.1 million. If they didn't do the conversion, if they didn't pay the $55,000 in taxes, how much tax is due on $1,113,000? Well, even if they're in a slightly lower bracket, let's say that they're in the 22% bracket, you're talking about $250,000 in taxes at that point, as opposed to $55,000 in taxes 20 years earlier. You're paying taxes on the money now to keep it tax-free so that all of the future growth is also not subject to tax. It just makes sense. I've said it many times in the videos. It's paying tax on the seed and not the harvest. Pay on the smaller amount and then allow it to grow, and don't have a partner in your growth. Don't have the silent partner, the IRS, Uncle Sam, in the growth of your retirement account. Because if they are, every time you earn $1, they earn a portion of that dollar. The sooner you can buy them out, the better off you're gonna be. Last thing I'll say, there's no limit on Roth conversions. We know that there's a limit on Roth IRA contributions. There's no limit on how much you can do as far as a conversion. You just have to be able to pay the taxes on the money that you're converting. If you're serious about Roth savings, if you're serious about creating tax-free retirement income, check out the Roth 401k video we've got. You can get a lot more money away per year while you're saving if you got a 401k option. I'll put it up here in whichever corner the cards go up in. Check that video out. Subscribe to the channel if you're enjoying things. I thank you for being here. I hope you learned something today, and I'll see you soon.